Welcome to the Deep Dive. We're your shortcut to getting truly well-informed on the big market-moving events. Today, we are digging into the Q2 2025 earnings call from a huge player in global mining. This is a company that's navigating a really complex commodity scene, but they seem to have a very clear strategy. Our mission here, to pull out the most important nuggets of knowledge, the key insights from this call, giving you the clarity you need, not just what happened, but, why it actually matters.
Absolutely. And we'll try to peel back the layers a bit, look beyond just the headline numbers. We need to understand the operational shifts, the strategic moves that are really shaping this company's path forward, especially, like you said, in such a volatile market.
Okay, let's kick off with a snapshot of their Q2 results, because this quarter, it really had some impressive moments that maybe seem a bit at odds with the market's kind of cautious feeling right now. They reported GAAP diluted earnings per share around 50 cents. Now, that significantly beat the consensus estimate, which was hovering around 34 cents. That's a pretty big beat.
It is, yeah. That EPS beat is undeniably strong, a clear sign of some internal muscle. But it does raise that key question, doesn't it? How do you square that with revenue actually being down 11% year over year? Revenue landed at $8.8 billion. Okay, that was mostly in line with what analysts expected, but that year-on-year drop, well, to me, it suggests there's more to the story. Adjusted EBITDA also slid, down 15% year over year to $3.39 billion. So yeah, how did they pull off such a strong EPS number when revenue was heading south? What's that telling us?
That really is the million-dollar question, isn't it? Because despite those dips at the top line, when you dig into their operations, that's where it gets genuinely interesting. They showed some serious improvements. Think about C1 cash costs. It's kind of the purest measure of mining efficiency, right?
Yeah.
The direct cash cost to get that ore out and processed before stuff like depreciation. So when we see their iron ore C1 cash cost drop to just 21 ores per ton, wow, that's not just a saving. It's an 11% cut compared to last year. It really speaks to some deep ongoing efficiency gains.
Exactly. This isn't just trimming the fat for a quarter. It feels like they're embedding cost control right into their operations. And it wasn't just iron ore feeling the love. Their energy transition metals, business copper and nickel especially, showed really substantial operational gains too. Copper output surged actually by 18%, hitting 92.6 kilotons. And nickel sales up 21% to 41.4 kilotons. These aren't just good numbers. They show a serious ramp up in the exact metals the world needs for the energy shift.
So you've got this kind of split picture, revenue and EBITDA down, but a powerful EPS beat driven by cutting costs and boosting output in key areas. But what's maybe even more fascinating is how the market reacted initially. You'd think with operations looking that strong and that earnings beat, the stock would have popped, right?
Right. But it didn't. Not really. Despite those strong internal numbers, the market's first take was kinda reserved. The stock actually slipped about 1.7% right after the call, and on heavy volume too. This really highlights a crucial tension. Is the market just betting on the overall commodity cycle? Or will it eventually reward this company for its, pretty remarkable operational grit and strategic direction? It seems like, for now, investors are weighing those global demand worries more heavily than these internal wins.
Yeah, that market disconnect is telling. We'll circle back to that bigger picture. But first, let's really get into how they achieve these results and, just as importantly, where they're trying to steer the ship strategically. Let's dig into the nuts and bolts, financials, operations, and their strategic shifts.
Okay, so starting with those key financials, that big EPS beat, it wasn't pulled out of thin air. Management pointed pretty directly to a huge $200 million reduction in all-in costs. That, plus a more efficient business mix. It really shows their intense focus on cost discipline, on optimizing the portfolio. That's what let them outperform expectations, even with revenue sliding.
And you look at their capital spending for the quarter, their CapEx, it was $1.1 billion, which is actually down $0.2 billion from last year. So you might think, okay, are they pulling back? But management was really clear. Their full-year CapEx guidance, $5.9 billion, that stays put. They said the lower Q2 number was mostly just seasonal timing, not a sign they're deferring future plans. So strategic spending, not just cuts.
It's quite a balancing act, isn't it? Investing while controlling costs. Which brings up the question, how are they pulling off these consistent cost reductions? On the operations side, this is the fourth quarter in a row they cut year-on-year C1 cash costs for iron ore. It's now $22.02 per ton for the quarter. That's not a fluke. It's a trend. It shows deep efficiency gains becoming part of the system.
Yeah, they're not just finding loose change. They're building cost cutting into how they work. And that focus definitely wasn't limited to iron ore. Look at the energy transition metals. Copper's all-in cost. It plummeted by 60%, down to just $1.4 thousand per ton. That's a massive improvement.
Absolutely huge. And it wasn't just raw efficiency gains either. That copper cost drop came from strong performance at their Salobo and Sossego mines, sure, but it also got a big boost from higher byproduct revenues, especially gold, with prices being higher. This success actually let them lower their full year 2025 copper all-in cost guidance even further, down to $1.5 to $2.0 thousand per ton. That could mean what, maybe a $300 million EBITDA improvement for the year? That's a direct financial impact from running things better and smarter resource use.
And nickel saw benefits too. Its all-in cost dropped by 30% year over year. They credited better operations at Sudbury and Voisey's Bay, successfully ramping up underground mines there, plus, again, higher byproduct revenues. So it's a consistent story across different key metals.
Yeah, management talked about an efficiency-driven mindset. They mentioned specific initiatives too, like Project Catalyst. Apparently, that project alone has already found $340 million in cash improvements just this year, and over half of that is in operating expenses. It really signals a proactive, system-wide approach to managing costs, something that goes beyond just reacting to the market.
So when you put all these numbers together, you see a company that seems to be deliberately shifting, pivoting towards resilience, towards metals that are key for the future. They're thinking longer term, not just quarter by quarter. They have this VALE 2030 vision, right? Building a top-tier mining platform, looking for growth that adds value, especially in copper and iron ore. It feels like it's about more than just growth. It's about building in resilience, maybe setting a new standard.
And you can see that long-term thinking in their concrete actions, can't you? Like getting the preliminary license for the Bacaba copper project. That's not just about getting bigger. It extends the life of their existing Sossego plant and adds 50 kilotons per year. And the capital intensity looks competitive too, about $5 and 4,000 high counter-dozen. So they're unlocking value from what they have while strategically expanding into these high-demand metals.
Exactly. And then there's the second Onça Puma nickel furnace. That's supposed to start up in Q4 2025. It's set to boost their nickel capacity by 30%, and they're saying it'll be very cost-competitive production. These feel like targeted, smart investments designed to reshape their portfolio mix.
Innovation's a big piece too, it seems. They talked about rolling out autonomous trucks, using real-time ore tracking for iron ore, and for copper, they're using process control AI, tweaking sulfide leaching processes. These aren't just buzzwords, right? They're actively using tech to squeeze out more efficiency, optimize how they run things, really pushing the envelope for mining.
Beyond the new tech, they're also tweaking their existing iron ore products, adjusting dynamically to what the market wants, revising some ore specs, boosting concentration capacity. And here's something that really caught my ear. Successful trials of iron ore briquettes. They showed excellent results in productivity and metallization. Now, that could be a genuine breakthrough for steelmaking, potentially greener, more efficient. Interesting stuff.
Very interesting. But while they're clearly focused on these operational wins and future strategies, management also didn't shy away from acknowledging those lingering ESG shadow costs. You know, the financial and reputational hangover from past environmental and social issues. For instance, literally hours before these results came out, that Brumadinho litigation from the awful dam collapse back in 2019 popped up again in a UK fee suit. It's just a stark reminder that these legacy issues can cast a long, expensive shadow even as the company tries to move forward.
So let's tie this all together. What does it mean for you listening in, thinking about this space? Despite that strong earnings beat, despite those undeniable operational gains we just unpacked, the VALE ADRs, their stock, it slipped about 1.7% right after the call. Heavy volume, too. It really suggests the market is still maybe primarily fixated on the big picture commodity price trends, not fully buying into management's optimism or these operational wins just yet.
Yeah, and connecting that to the wider industry, well, it is a tough backdrop. Iron ore fines average $85 a ton, down 13% year over year. Steel demand globally is soft. You see peers guiding for basically flat volumes. But this company's position on the low end of the cost curve, plus its growing mix of copper and nickel, that does position it defensively in a volatile environment. That focus on future metals is a real differentiator compared to miners still heavily reliant on just iron ore or coal.
That defensive angle is key when commodity prices are weak and offer some insulation others might lack. And management, they were very explicit about shareholder returns. Always good to hear.
Right.
They announced a $1.4 billion payment interest on capital for September. That's right in line with their dividend policy.
And they didn't stop there. They also dropped hints about possibly more dividends or even share buybacks in the second half of the year, especially if their net debt gets closer to the middle of their target range, around $15 billion. The board even approved using derivative instruments for buybacks. That shows a pretty proactive, maybe even sophisticated approach to returning capital. And management directly addressed what they see as a mismatch between how the company's performing operationally and how the market is valuing it. They basically said, hey, we think our stock is undervalued.
That's quite a statement for management to make publicly. It suggests they see real value the market isn't recognizing. So looking ahead, what could change that perception? What are the catalysts? Well, the Q3 production and price update in late October 2025, it's definitely one to watch. Then there's the first ore from that Bacaba copper project expected in the second half of 2026. We talked about how important that is.
Beyond those milestones, keep an eye out for potential joint ventures, maybe in energy transition nickel. That could speed up their strategic shift. And of course, there's always the potential for iron ore prices to turn, maybe linked to Chinese stimulus efforts. That's a perennial factor for the whole sector. The big long-term story here is this migration away from relying so heavily on one commodity towards a more balanced portfolio infused with battery metals. If they can really deliver on that transformation, well, that could unlock significant value, even if commodity prices stay lower for longer.
Okay, let's shift gears slightly. This next bit is purely a thought experiment. For you, the savvy investor listening in, just a way to think about market dynamics, potential scenarios. Remember, emphatically, this is not financial advice. We're just exploring possibilities.
Right. But given that disconnect, we talked about strong operations, clear signals from management about returns versus a stock that dipped and that management itself calls undervalued, you can definitely spin out some speculative scenarios.
Indeed. So here's a, let's call it bold, but maybe plausible market hypothesis. If management is genuinely serious about buybacks, and especially if they plan to use those derivative instruments for efficiency, how could that actually play out? Imagine they come out and announce a really aggressive buyback program.
Exactly. You combine their stated readiness for buybacks, their public assertion that the stock is mismatched valuation-wise, and maybe you look at some of that options activity right after the call, especially in the near-term calls. If they move decisively, maybe using derivatives to speed things up or manage volatility, well, that could really squeeze implied vol and potentially force the market to re-rate the stock pretty quickly.
It wouldn't just be about soaking up shares, right? It's a powerful signal of conviction from the very people running the company. They're putting money where their mouth is, saying, we believe it's cheap. That kind of aggressive capital move could force a rapid revaluation, maybe even trigger a short squeeze if conditions are right. It's a high conviction scenario, playing on management's words, meeting what they see as market undervaluation.
Yeah.
Again, not a trade reckon, just analyzing how strong signals and actions can potentially move a price, especially when there's that perceived gap.
So that kind of wraps up our deep dive into this latest earnings call. What we've seen is a company showing really strong operational muscle, impressive cost control, especially given how tough the commodity price environment still is.
Yeah, and their strategic pivot, that shift towards energy transition metals like copper and nickel, plus the focus on innovation and shareholder returns, it paints a pretty compelling long-term picture, one of resilience and future growth.
But that immediate market reaction, the stock dipping, it really hammers home how much broader commodity prices still matter. It raises that key question for you listening. How much has the market really priced in this company's operational strength and its long-term strategic shift versus just reacting to the day-to-day commodity swings?
Definitely something to ponder. We'd encourage you to keep an eye out for their Q3 production and price updates. Those are coming in late October 2025 and should give further clues. Thank you for joining us for this deep dive. We hope this gave you some valuable insights and a deeper feel for this really interesting market event.